Rules around inheriting an IRA have recently changed, and now there's even more clarification about what you are required to do. We think there's 4 things that you should know. I am Bridget Sullivan Ramel. I've got a family financial planning practice in Chicago, Illinois.
And I'm John Shear. I've got a fee-only financial planning practice in Middleton, Wisconsin. Before we dig into the 4 things you need to know about inheriting an IRA, we want to remind everybody to hit that subscribe button, help other people find this information on YouTube. And with that, let's jump in and talk about inherited IRA issues, Bridget.
Okay, John, let's get it going. Start with number one.
Yeah, it's interesting as you had said in the introduction here, right? It's the rules have really changed. I think I was looking the other day, there's been 3 major tax law changes in the last decade that and in various fashions have affected this stuff, right? And so you think, oh yeah, that's right. I inherited an IRA from my dad, 10 years ago or 15 years ago or whatever it is. And the rules have changed, and maybe they've changed how it affects what you're looking at here, or what you have to do as you inherit one. And one of the big changes that we talk about a lot with our clients is that it used to be that you inherited an IRA, right? My mom passed away, I got her IRA, I was the beneficiary. I then had to take a little bit of money out each year. It's called a required minimum distribution. I have to take some money out using this RMD, but I could stretch it out over the course of my lifetime. I was 40 when I inherited. I have to take a little chunk out each year for the next 30, 40, 50 years, right? That rule changed, and now the rule is when I inherit that IRA from my mom, I've got 10 years and I have to take everything in that IRA out in 10 years. And why is that important? That for regular IRAs, when that money comes out, it's taxable as regular income. So I've got 10 years to add all this regular income on top of my, other income from my job and that sort of thing. So that's a really big change that when somebody inherits, of course, if you inherit, 10 or $20,000, it's a great, sort of gift type of thing. But from a tax standpoint, that doesn't change the numbers a whole lot. The problem comes when somebody inherits $1 million IRA, right? A life-changing number, but then suddenly it also is a tax-changing number that we've got to be aware of. And not everybody is aware that when they inherit this, they've got to start taking that money out, or they have a 10-year time frame to do that.
Yeah, and one thing I would just want to make sure is clear is there's a, what do you call it, a grandparenting type of provision. So if you inherited an IRA from somebody that died before this law came in, you're still okay. You got the rest of your life to take the thing out.
Right.
But if it's more recent, then you've got to follow this 10-year rule.
That's right. That's right. And so if you are already in a position where you're taking out those distributions, I believe that the drop at dead date was at the beginning of 2020, but look that up, right? The specifics, we can look all those things up. If you're already doing it, you can probably keep what you're already doing. But if you inherited this in the last 3, 4, 5 years, go back and take a look. We've got some folks that have been taking out those minimum distributions. And then they come to us as clients, and then we find out, hey, wait a minute, you've got 6 years to drain the rest of that account, right? We got to do some planning on that to try to figure out when's the best place to take that and what's the most tax smart way to do that stuff with, right? So just be aware, if somebody dies today, clearly it's in that 10-year rule. If it's in the last 5 or so years, go back and take a look, right? There's some homework from this lesson or from this episode here. And talking about taking money out from an inherited IRA, also just one of the things to be aware of is that you're allowed to take it all out at once if you want to, right? You got $1 million, you can take it all out. As you might imagine, though, the downside to that is, remember, we're saying all this money, we're talking regular IRAs here, all this money coming out is taxed at regular income tax rates, right? So while you can take it out all at once, you probably don't want to from a tax standpoint.
Yeah, it's like, so for instance, I had someone I was talking to inherited about $250,000 in an IRA, and they are in the 10% bracket, if that. I'm sure a lot of years they don't even file taxes. Okay, so they had the idea of taking the money out and paying off the mortgage. Okay, it's a different episode about paying off your mortgage when you're retired. We have a nice debate about that. But if this person took out the $250,000, they go from paying like almost zero in taxes to the $250,000 bracket. Okay, so, and they might have withholding on that taxes. So the net would be maybe they get 180 or something, but that withholding might not even be enough. They might owe more. The person was single. So my 2 cents was like, geez, at least spread it out over 2 years, if not three.
Right. I was just,
If you've got some use for it that you want to do now.
yeah, yeah, so you can, but I love that idea. I was thinking as you're describing that situation with your friend about, well, wait a minute, what if you take out, $50,000 a year each year for 3 or 5 years, right? And then rather than paying 24 or 32% in taxes or whatever that bracket is, maybe now you're only paying, 12% or even 22%, right? Like managing the brackets as it goes along. So know that you can. Sometimes on the flip side, we get people that inherit an IRA and they maybe in the old days they were taking those minimum distributions and it's a $25,000 IRA. And again, a great amount of money, but when you've got to figure out and take out $1,200 this year and 1,500, and you go, well, geez, maybe it makes sense just to take it all out. If we're going to pay in the same tax bracket, maybe it makes sense just to empty that and have, simplify our lives from a tax and financial standpoint, right? So on one end you go, geez, maybe you want to take it all out rather than doing that minimum distribution thing or waiting 10 years or whatever. And then on the other end, you go, even if it makes sense, and the episode that we did on paying off your mortgage in retirement, like, yeah, we don't necessarily agree with that, right? Paying it off. But if you want to, spreading it out over a few years could make a big difference in actual tax dollars, right? And so
Yeah.
just knowing that both those sides of it, you have those options.
Yeah.
The other,
If you take out $250,000 from your IRA that year, you look like somebody who just made $250,000.
right.
Might not be how you perceive yourself or what your situation actually is. So just be mindful of it. If you don't have to take it out all at once, and it's probably in lower amounts, like you bring up, probably better off not taking it out all at once.
I love that description of it. Looks like you made this much money, right? That's a really because listen, if I'm living on Social Security or whatever my situation is, I don't think of myself as having made $250,000, right? The tax man says you did. I think I just took this money out to pay off my mortgage, right? But from a tax standpoint, it's like you earned that money and you made that kind of dough, right? And so just being sensitized to that and being aware of that thing.
Okay, we got more points. Let's move on.
Yeah, I was thinking on a similar line on that what there are some exceptions, we're talking in generalities about how all this stuff works, and this applies to, 85 or 95% of people. There's one place that is a very common inheritance issue with IRAs, and it comes when you're a spouse, and a spouse has different rules than other people. And one of the main different rules is that as a spouse, if my spouse dies, I can take her IRA and I can have an inherited IRA, which is a specific tax thing, or I can take her IRA and I can turn it into my own and consider it my own IRA. Right? When my mom dies, in general, I say, listen, I take her IRA, I have to have an inherited. If it's not a spouse, it's 99% of the time that's an inherited IRA. It kind of works like a regular IRA, but it is specifically different from a tax standpoint. But when I'm a spouse, I can take my spouse's IRA and turn it into my own. And so it's important to be aware that you can do this. But then but the other thing about it is many people in the financial world say, oh, it's your spouse. You should take that money and turn it into your own IRA, which is the right answer most of the time. But there's one specific place I want to bring up where a spouse might not want to have that be their own IRA. And again, in general, that makes sense. But here's the situation where, and I had a friend where she was in her early 50s. Her spouse was quite a bit older than she was. So I think he was around 70 or so when he passed away, right? So he's 70, she's 53, let's say. He dies. Now she's got his IRAs, right, available to her. What should she do? And we're talking, and she said, well, my investment folks, I should turn it into my own IRA. I think that's what I'm going to do. And she can do that. But here's the place where if she was living off of that money, hey, I'm taking distributions, right? I'm married, my spouse is retired, we're taking distributions from his IRA to live on. If I turn that into my own IRA and I'm 53 or 55 years old, guess what? My IRA as a 53-year-old, I can't access that without paying penalties until I'm 59 and a half, right? Many people are aware of that 59 and a half rule. It's kind of sticking out there. We've got past episodes talking about that, right? But if I inherit the IRA, I can take distributions from that from an inherited IRA with no 10% penalty. From my IRA, I generally speaking can't take the money out before 59 and a half without paying a 10% penalty. And so it's this one set circumstance where if there's an older spouse that passes away and you're not 59 and a half, make sure you think about that. It might make sense to do it either way, right? But don't just automatically default to, hey, I can turn it into my own IRA. That's a big one, I think.
That's a really important question, a really important issue. Yeah, that's an awesome exception to the rule, and it happens more than people think, I think.
That's right. That's right.
Um,
Hey, let me jump in on one more thing, if it's okay, Bridget. There's one other thing that was on my mind as far as our topics of things is when you inherit an IRA. Again, I've got this separate tax thing. Let's assume I'm not a spouse and turn it into my own. I've got an inherited IRA. One of the strategies that we talk about quite a bit is doing conversions of IRAs to Roth IRA for tax purposes. An inherited IRA, we can't do that directly. There are some backdoor ways we can maybe do it, but an inherited IRA in general, we can't convert that to a Roth IRA. But what we can do with an inherited IRA is if I were over 70 and a half, we can take IRA money from an inherited and give it to a charity using the qualified charitable distribution, but I can take money out of the IRA and not pay taxes on it by giving it to charity. So if that circumstance would be, listen, I inherited an IRA. I'm over 70 and a half. I've been writing checks to my church and to United Way and wherever I give money to. Well, geez, why don't I take it out of this inherited IRA and avoid the taxes on those distributions, right? So you can do a qualified charitable distribution, give money to charity from an inherited, but you can't do the Roth conversion thing.
yeah, and that's a nice way to make your charitable contributions if you're in a situation where you've got an inherited IRA and you're over 70 and a half. Yeah,
That's
that's a
right.
nice way to do it. It's nice and efficient.
Yep. Well, hey, I
Well,
think that's a great place to wrap things up here and talking about inherited IRAs and some of the issues that aren't typically talked about. Again, I'm John Shear and I run a fee-only financial planning practice in Middleton, Wisconsin.
I'm Bridget Sullivan Mermel. I've got a family financial planning practice in Chicago, Illinois. John and I are both taking clients, but if you're interested in finding an advisor in your area, we're both members of ACP, or the Alliance of Comprehensive Planners, and you can find an advisor in your area at acplanners.org.
And don't forget, hit that subscribe button.